All right, well, today's jobs report closely watched for the market for how it sets to guide the Fed's fight against inflation, as rising interest rates really contributed to the regional bank collapses. Now, that instability shifting the views of some experts from a no landing scenario for the U.S. economy to a hard landing. Joining us now with more, we want to bring in Torsten Slok, Apollo Global Management Chief Economist. Apollo Global Management is the parent company of Yahoo Finance. Torsten, it's great to see you here. So job growth cooling a bit, 236,000 jobs added. Unemployment, though, also ticking lower. What's your big takeaway and how the Fed is potentially looking at this report?
Yeah, in some sense, this report on its own is indeed Goldilocks. We got lower inflation because wages came down to 4.2 from 4.6 last month. And we also at the same time had that employment growth came down from more than 300,000 last month to now 236. So in some sense, we still have an economy that's doing okay. And at the same time, inflation is coming down. That being said, the risk, of course, when you take a little bit further look back, is that employment growth has been declining quite substantially in the last 3 months. And it was already the effects of the Fed hiking rates that we are seeing in the labor market slowing. And if we add on top of that, the banking crisis that we're going through at the moment, then of course the risks are still there that the slowdown in the labor market over the next several months can continue. So in other words, yes, so far so good. There are some issues also about other indicators, as Jen also just mentioned, that in particular the number of job openings have been declining a bit faster. Yesterday we got jobless claims, which was a little bit higher than what we would have expected. So all in all, the conclusion is that the labor market is cooling down. And the issue for the Fed still is that it needs to cool down in a gradual fashion over the next several months. And the risk is that whether that will happen or whether we might get a sharper slowdown.
It sounds really cool and measured when we say cool down, Torsten, but the reality of it is that the Fed is still going to be looking for where this bad data continues to show a trend over an extended period of time in order to hit some of their dual benchmark goals here. So how many consecutive months of bad or cooling data should we be expecting for the Fed to actually look for here?
Yeah, there's a really important question. I think this week, at least, it did show quite a downside surprise on a number of different fronts. We also got ISM services, which is the service sector that came in lower than expected. We also got ISM manufacturing, which was also lower than expected. Remember, when ISM is below 50, that is by definition that the economy is in a recession. And on both fronts, we have seen a deterioration where both the service sector and the manufacturing sector, which are the two sectors in the economy, have been slowing down. So the impressive thing in this number is still that the labor market is still doing okay. There's still a lot of anecdotes about companies that are looking for workers, but there's certainly also more and more anecdotes. If you look at the warn notices, which is basically companies have to pay in advance if they lay off workers, that's been picking up. We've also seen, as I mentioned, jobless claims picking up, meaning the weekly data of how many people apply for unemployment benefits. That's also been softening. And overall, combined with fewer job openings, combined with the slowdown we saw in this number here for non-farm payrolls being weaker over the last few months, it still points to an economy that's slowing down. And that's not surprising. The whole idea from the Fed side is to raise interest rates, to slow down consumption, slow down capex spending, and slow down hiring. So we should expect that process to continue. The only issue now is if we are adding on top of that a tightening in credit conditions, if it becomes harder to borrow money for your credit card or for buying a car or for building skyscrapers and buying factory equipment for companies, if those things slow down again over the next several months, we may run the risk that slowdown could come a bit harder. And that means that, therefore, that the labor market could slow down faster.
Yeah, Torsten, what did you make of Bullard's comments earlier this week? He was really downplaying the risk of a credit crunch. It sounds like maybe you're starting to see some signs of it, the potential fallout from that, and how significant that could be.
Yeah, no, I'm quite worried that, some of the indicators that have come out since Silicon Valley Bank collapsed in early March, they do show that there's been quite a pullback in loan volumes. Specifically, the Federal Reserve Bank of Dallas, when they surveyed their district from the 21st of March to the 29th of March, which was after Silicon Valley Bank failed, then they find that 71 banks and credit unions have seen a very significant reversal in loan volumes. In other words, lending to consumers, lending to corporates, lending to commercial real estate and residential real estate. So at least some of the indicators that have come out since Silicon Valley Bank have suggested that maybe the tightening in credit conditions, in particular for the regional banks, is more severe. Remember, the regional banks make up 30% of assets in the banking sector and 40% of lending in the banking sector. So the regional banks, they do play a quite significant role in the banking sector overall. And if they start to step a little bit harder on the brakes, that raises the risk of the economy, which was already slowing down, could potentially slow down a bit faster.
Do you foresee a potential for a liquidity event, a massive liquidity event taking place in the back half of this year that would then push the Fed to pause or even cut rates?
So I think that it is correct to say that the immediate risks in the banking sector are now over. What really is the key issue here is that there were some very intense things in the banking sector that played a very significant role in markets and everything we've been through for the last few weeks. But what is really critical for investors, and in particular for the S&P 500, is to now ask the question, what is going to be the behavioral change in the banking sector, most importantly in the regional banks? If the regional banks, again, which account for 40% of all lending in the banking sector, begin to pull back, if they stop lending to consumers, to corporates, to real estate, well, then you run the risk, of course, that the slowdown that is already coming because of the lagged effects of Fed hikes might be coming a bit faster. So the risk from here is that I don't see as such a liquidity event, but I see that the Fed having already raised rates, and if you add on top of that banks that are tightening credit conditions, making it harder to borrow, is of course a risk to the downside. The next data point on this front here is that we will on May the 9th get the senior loan officer survey from the Fed. So that will tell you something about how much are the banks pulling back. But it's very clear that so far, at least the indicators we have up to this point, are suggesting a pullback and a continued deterioration in credit conditions in the banking sector.
Torsten, just lastly, while we have you, one of the charts that you had pointed out earlier this week, I actually got this from your newsletter, was the labor force participation rate and the potential for it actually being above the pre-pandemic marker. With the read that came in today, does any of this signal that the labor force right now is seeing a massive slowdown, even though we are seeing some lightness in the number of ads month over month?
Yeah, this is very, very important. So if we really step back and answer that question, then I think that we should be looking at, well, during the pandemic, we saw a significant hit to the labor market. There were 22 million people who lost their jobs in March and April of 2020. And we saw a significant reshuffle. Those people have now found jobs in all kinds of places, but we still have a significant amount that are outside the labor market relative to where we were before the pandemic. And the number we got today did show a tick up in the labor force participation rate. So the good news is that more people are coming back to the labor market. But that process, because it was simply so many, more than 20 million people, that process of getting people into the right jobs and the right places and getting people ultimately also back to the labor market is just taking time. And that has taken some time so far. And that is why the labor market still remains reasonably tight, simply because there were so many people who left during the pandemic, and they are now gradually coming back. And that's, of course, why wage inflation is gradually, therefore, also moving lower, which is, of course, also good news from the Fed's perspective in terms of ultimately getting inflation down from currently the level of, in round numbers, 5% inflation back to their target of 2%. But it's going to take some more time before we get to that. Probably by the end of this year, things on the inflation front are going to look a lot better than where we are right now.
All right. Well, that indeed is some good news on the inflation side. Torsten, thanks so much for taking some time here on this Jobs Friday with us. Torsten Slok, who is the Apollo Global Management Chief Economist. Appreciate it.